This is Fritz Meyer on the 15th of January, and today Andy and I thought we would review the questions that came from the January webinar that we did on the 13th, a couple of days ago. And so the first question that resulted from Tuesday's webinar is, on the household net worth slide, doesn't it appear that we're headed once again well above the trend line? Well, let's look at that slide. Here's the slide we were looking at, and the answer to the question is yes, it could well be that we're headed back into, let's call it, irrational exuberance territory. But by the same token, if that ends up being the trajectory, we are only in early days. Which suggests to me that if the danger of inflated household net worth, that is to say household net worth rising above the long-term trend rate of appreciation, is that households begin to act irrationally exuberant and start making speculative decisions because they're feeling so flush with cash, which was coincident, as you can see in this slide, with the last two stock market bubbles, and the most recent bubble included a real estate bubble. Well, if that's the danger, then I think we're still a ways away from that situation, to the extent that it ends up developing in that manner. What I pointed out in the webinar, though, is that conversely, the data in this slide is very positive in this regard. Post-recession, household net worth slumped well below the long-term trend, and this is when people were, consumer sentiment readings, for example, were absolutely down in the cellar. People were feeling poor. They had just lost substantial fortunes in some cases in both real estate and the stock market, and that affects consumer spending negatively through the so-called negative wealth effect. Well, that's all in the past, and that's the good news here. And so as a result, I think we are seeing the recovery in the University of Michigan consumer sentiment readings that I discussed in Tuesday's webinar, and we're seeing consumer spending data trending back towards normalcy. And so that's all good news, both for the economy and for the stock market. Second question is, assuming the oversupply in oil prices is due to less demand, why is there less global demand for oil? Well, as a matter of fact, the question as stated is simply not accurate. The collapse in oil prices, as I tried to describe in Tuesday's webinar, was I think most obviously due to consistent oversupply starting in November of 2013 and lasting all the way through October of 2014. But then the interesting most recent data point that I was pointing out is that, guess what? In the November data, the most recent data points in this chart, you saw supply take a hitch down and demand take a hitch up. November supply dropped and consumption popped. And that's what I find so intriguing about this most recent reading on both global supply and demand for crude oil. Getting back to the question, no, as a matter of fact, as you can see in the dotted line in this chart, we are still at record all-time high in global demand. In other words, the problem has not been a tapering off or a decline in global consumption. It was the fact that global supply had been outstripping that very robust growth even in global consumption. Supply had been growing even faster than the very healthy rate of growth that we've seen most recently in global consumption. Do you think the increased cost impact of the ACA is properly accounted for in these projections? The story on 60 Minutes on Sunday confirmed what we all know, in that the law will not control costs as it originally touted. I think the reference in this question to projections probably was my referring to both the most recent forecast for U.S. GDP growth, which, as you'll recall, was something, most economists expect something on the order of 3% GDP growth looking out through, all the way out through 2015 for the next 5 quarters. And that being a rather robust, or at least a very healthy rate of economic expansion here in the United States, particularly compared to many of the quarters and years post-recession. The phrase being anemic recession and so forth having been very common. The question of ACA is a good one. First of all, it's a great question because a lot of people are really very skeptical of the ACA. That, by the way, that ACA is the American what is it? It's Obamacare, but it's I've forgotten. I'm sorry, I've forgotten the name, what the official name of Obamacare. But the point is that Obamacare could in fact be a brake on, or a damper on, economic expansion in the United States going forward. Here's how I look at the ACA. The debate over Obamacare really is a debate over both the means to finance.
Affordable Care Act. It's Affordable Care Act. Sorry.
Affordable. Thanks.
I was muted.
I just couldn't remember the acronym. Thanks. The debate over the Affordable Care Act really is a debate over, number one, the means to finance health care for Americans, and number two, the means to deliver health care to Americans. And in my view, that's a very different subject or issue than health care as a driver of the economy, as a key driver of economic growth. In other words, how you finance and how you deliver health care is separate and distinct issue from the fact that growing demand for health care in this country will continue to drive economic expansion. So I wanted to show you this chart because in terms of jobs, for example, lo and behold, the category entitled Education and Health Services is the single biggest employment category among all job categories, and it's been one of the fastest growing and, furthermore, one of the most consistently growing sectors of all employment categories here in the United States. And look, it didn't turn down one smidgen even during the recovery. Growth in health services employment motored ahead right through the last recession. It's an extraordinary statement, suggesting that growth and demand for healthcare services will continue at a robust rate for the foreseeable future, in large part driven by demographics. And therefore, getting back to the question, I don't think that the outcome, the ultimate outcome, with respect to possible changes in the Affordable Care Act really is particularly material to healthcare as a driver of economic growth, which is to say, I think economic expansion here in the United States will continue at a pretty healthy clip regardless of how Obamacare gets changed or doesn't get changed. My personal view is that I think the ACA will get changed, probably incrementally over time, such that its provisions become gradually more acceptable to the vast majority of Americans. And at present, I would say that's not the case. I think a vast majority of Americans probably are relatively unhappy with the Affordable Care Act as currently structured. So changes are probably inevitable, but whatever those changes may be, I don't think it affects one way or the other the fact that healthcare will continue to be a substantial driver of economic expansion. Next question is referring to page 28, and that was the Goldilocks slide. What about the decline in real wages last month and year-over-year wages growing at less than inflation, with continued decline in the labor participation rate as a negative? And a follow-on question, and related, which is why I put it together on this page. If employment was strong and at mid 5% unemployment, wouldn't wages be higher by now? So I want to take this opportunity to go through a set of 5 slides that I've prepared in response to this question. First of all, what you can see here is average hourly earnings, and importantly compared to inflation. The most recent data point, the December average hourly earnings that was just reported, is a downtick. And this is what I think a lot of people were commenting on in the last few days on CNBC and elsewhere. So just that one December data point, I think, has managed to cause a fair amount of consternation with respect to the trajectory of average hourly earnings. And that's why I prepared this slide, because 1 month does not make a trend. Whereas you can see the extraordinary persistence in the trend of steadily growth in average hourly earnings. And furthermore, and this is what's so surprising about this data, I think, to me and perhaps to you when you look at this data, is that actually, and unbelievably, I think, to a lot of people, real wages are actually accelerating, which is to say the gap between average hourly earnings and inflation has actually been widening. And so this brings up, I think, a really significant issue at the current juncture. Inflation has been trending lower, lower, and lower, contrary to what the Federal Reserve has been both expecting and trying to engineer. They've been trying to engineer a rise in the inflation rate, and in fact, inflation continues to decline, a function of both slumping commodity prices and the fact that we've had no wage gains. I tend to believe we're going to be, for the foreseeable future, in a continued, protracted period of disinflation, which is to say lower inflation, surprisingly below what most people are expecting. Which is to say that if average hourly earnings then maintain this pace, real purchasing power for average Americans is actually rising. Wow, what a concept. Because the press, the media, generally talk about the average hourly earnings statistic, not referring to adjusted for inflation. Whereas purchasing power, theoretically and in reality, if you believe these statistics, and there's no reason not to believe these statistics, real purchasing power is actually increasing in a disinflationary environment such as we have today. Here you see the same concept illustrated with the actual calculation of real wage gains year over year. And you can see that, as a matter of fact, over the last 2 years, since 2012, real wage gains have been consistently over zero. We've been consistently experiencing gains in real wages. Again, tell me this isn't a surprise. I think it's a big surprise to so many pundits who have been decrying the fact of declining wages and declining real purchasing power. Not true. Not true, according to the statistics that I'm showing you. Here's another slide that shows disposable personal income. Yes, post-recession, it took a hit, but since the end of the recession, you can see that we've resumed this gradual long-term progression higher in disposable personal income, and this is real per capita income, which means it's adjusted for inflation and also per capita, suggesting again a steady increase, and specifically 1.5% year over year increase in real per capita income over the last year. Again, a big surprise, I think, to many who would describe the current wage trajectory as being discouraging. Not in the context of a disinflationary environment, and that's the key consideration and something that a point that really needs to be made very clearly. And then finally, this is aggregate nominal disposable income. The preceding chart was real per capita. In other words, the preceding chart was adjusted for inflation. This is before adjusting for inflation, so this is the one that gets reported. And you can see that we've seen, and it's not adjusted per capita, so it's aggregate growth in disposable personal income. The reason I wanted to show you this chart is, yes, on the one hand, it's not been growing recently at the long-term 5.3% trend line, but again, we're having declining inflation, so one would expect the nominal rate to be slowing. But secondly, and more importantly, at 3.7% year over year, most recent rate of increase in aggregate disposable personal income, that's a pretty healthy growth rate. And the reason I wanted to show you this chart is this number is what drives this number, personal spending. So disposable personal income from the preceding chart, the red line is the red line in this chart, and the red line in this chart drives the black line, personal outlays, and it's the black line that constitutes 70%, actually 68% of GDP. I wanted to make that point because, again, many pundits and many of in the media have been decrying this slowdown in wage gains month over month, year over year. But I think the significant point is, yes, on a nominal basis that's happening, but what's happening on a real purchasing power basis? And actually we're making headway there, point number one. And point number two is that the nominal figure, as reported, is and has been adequate to drive a reasonable rate of GDP growth. So for example, let me take you through that calculation, 4% growth in personal spending minus 1.2% most recent PCE deflation leaves you with 2.8% growth in real personal spending. 2.8% is what drives GDP. And so that's where we're coming out with approximately 3% GDP growth. So, because remember, that's 68% of GDP. Then on top of that, you have growth in business investment, government spending, and net exports. So 4% nominal growth in personal spending drives 2.8% growth in real personal spending, to which you can add incrementally from the other three sources contributing to GDP growth, and that's precisely how we get to 3% GDP growth. Are the jobs being created simply low-wage jobs? Great question, and it's something that we constantly hear refrained from the media. We're just creating low-income jobs. Hamburger flippers, remember that phrase going back 2 decades now, but that's when Ross Perot was running for president. A nation of hamburger flippers. This consideration never seems to go away. And the answer to the question is no, we're not. So here is the entire array of employment by category. And the categories that you see in this chart represent the entire 100% of total private sector employment. And again, I was pointing to this chart earlier when I was talking about how healthcare jobs have been the biggest, the fastest growing, and the most persistent growing. You can see that at $24.89 an hour on average. That's not a hamburger flipping job. Now, hamburger flipping and the classic low-wage jobs, working at a McDonald's and so forth, are captured in the leisure and hospitality, and that's the $14 closer to minimum wage jobs. Well, consider the fastest growing and the largest categories are more than 2 times those minimum wage jobs, actually in excess of 2 times the minimum wage and 2 times the average in the leisure and hospitality. Okay, so I think that probably makes it as clear as one can make it. And this related chart is a calculation of the 12-month year-over-year absolute change by jobs category. Another way of saying it is, over the last 12 months, we've created over 700,000 net new jobs in the professional and business services. We've created 12,000 net new jobs in oil and gas extraction, which is another story as well that I wanted to get into just a little bit in a second. But the point is that the biggest sources of new job creation in the economy over the last 12 months are indicated here in order. And again, the biggest sources of net new jobs are not just low-wage jobs, as I just pointed out. They are more than 2 times, averaging more than 2 times the low-wage category that you find in leisure and hospitality. And then looking down at other categories here in the financial services industry, in the wholesale trade, information, and oil and gas at $41 an average. So overall, here's another statistic that I wanted to call to your attention. Overall, net new jobs created over the last 12 months averaged $24.57. Again, about twice the low wage category at $14 an hour. And the minimum wage, I think, is national minimum wage is still $8.50 or $9. So again, I think that's a misperception that all we've been doing is creating low wage jobs. We've been creating jobs across the spectrum, most categories for which you have substantially in excess of the low wage, and half of them are over the average $24.57 and half of them are under. Just a quick comment on oil and gas extraction, because another question that came from last Tuesday's session from one individual who sent me a question directly, and it was, I thought, an excellent question as well, is if most of the new jobs that we've been creating in the last couple of years have been coming from the oil and gas sector, then with a slowdown in drilling and consequent layoffs, is the new job formation engine put into neutral? I'm paraphrasing his question. It's a great question, and the answer is, well, first of all, the premise is mistaken. But I think a lot of people probably are under the impression that the preponderance of new jobs created over the last 12 months have been coming from the energy sector. Guess what? The statistic is that only 12,000 net new jobs were created directly in oil and gas extraction in the last year. Now, that doesn't include incremental hiring that we've experienced in manufacturing, tubular goods, for example, oil field equipment, or in retail trade, to the extent that in the states like Texas, North Dakota, Colorado, New Mexico, Ohio, Pennsylvania, we've had a multiplier effect in the economy, no question about it. So we have seen hiring across many sectors that have been related to the energy boom. But I think the bottom line is that that concern probably is not is probably to a large degree unfounded. In other words, the nice trend that we've seen and the very constructive trend that we've seen in net new job formation over the last 12 months is not going to be derailed by some expected contraction in the energy sector. You're going to have very significant offsets coming from all of these other categories, beginning with professional and business services and so forth. Or are there more people dropping out of the workforce than looking for jobs? Okay, so a couple of slides in this regard. First of all, with respect to people dropping out of the workforce, these people actually are picked up in the so-called marginally attached in the Bureau of Labor Statistics calculations. That's a point that I wanted to make, and this is a very busy slide with a whole bunch of definitions. But the point is that the Bureau of Labor Statistics computes something called the U6 unemployment measure, which is defined down here. Total unemployed persons plus all marginally attached workers plus all persons employed part-time for economic reasons as a percent of the civilian labor force plus all marginally attached workers. Okay. What are the marginally attached? Those are persons not in the labor force but who want and are available for work. In other words, they've dropped out, they've dropped under the radar, they are no longer counted in the labor force, but they are picked up in this U6 statistic. So that's why I spent some time on Tuesday, first of all, describing and illustrating the trends in both the U3 statistic. The U3 in this slide is total unemployed persons, and that's the official unemployment rate that we see released, the high-profile unemployment statistic that we see every month, and that just hit 5.6% right here. But the U6, in many respects, is the more important of the two at the present time, because that one is what so concerns all of us who are worried about a shadow, let's call it a whole population of unemployed people who are no longer being counted, presumably, but who would like to get back into the workforce. But they are being picked up in this statistic, is my point, the marginally attached. And the point I was making is that Janet Yellen in particular, I think, is and will continue to be very concerned about this shadow unemployed workforce. And unless and until the U6 statistic gets back to, let's call it normal, somewhere back close to 8%, for example, I don't think that her Fed will be satisfied. And that's why I was making the case that, you know, I think this Fed is going to be very dovish for a very long time until all of these people everybody who would want a job and who is no longer being counted among the employed or the labor force even is back working. And I maintain that that's the case because I think the other part of the dual mandate, 2% inflation, is going to be a no-show for the foreseeable future, and if anything, inflation is heading the wrong way as far as the Federal Reserve is concerned. Now here's a related concept that I think deserves some attention, and that's the labor force participation rate, because the question that was asked also relates to labor force participation rate. And again, this is a statistic that many pundits and even economists and also people in the government have been pointing to, this decline in the labor force participation rate. And a lot of people have been saying this is really a bad trend. I don't know if it's good or bad, but my observation and what I wanted to pass along to you is the fact that it is in decline, and very likely it is a secular decline driven largely by demographics. And that's why I went all the way back to 1950 to show you the history of labor participation in this country. Because I think what's happened is we've just seen 3 decades, if not more, of rising labor force participation as a function of the baby boom generation. And with the maturation of that generation now, in large part, I think that's what's behind this secular decline in the participation rate, which I don't think necessarily is a negative, but you just have to understand what's driving it. Which is to say we can continue to have healthy economic growth, notwithstanding an ongoing decline in labor force participation. You just end up with a slower rate of economic growth going forward than what you had during years of increased labor force participation rate. Because remember, the two the two independent drivers of economic expansion, GDP growth, are growth in the labor force plus productivity gains. If the labor force, because of a declining participation rate, is not going to grow as fast, it will continue to grow, but is not going to grow as fast going forward than we've seen post-World War II, then yeah, you do have to expect 2.3% GDP growth going forward compared to even 3.5% in some of the decades post-World War II. But nonetheless, at 2.3%, that still will remain a pretty respectable rate of economic growth going forward. And the other part of this chart is that clearly also it's affected by cyclical considerations, specifically recession. So you can see the participation rate has dove every time we've had a recession, and this most recent very extreme recession exacerbated the trend to the downside. But just recognize that there are both secular and cyclical factors at work with the participation rate, and with an improving economy you might see some stabilization even in the participation rate, going counter to the long-term secular declining trend. What about 15% of Americans on food stamps, over 46 million for over 4 years? Just a few examples of some negative economic figures creating a seemingly mixed economic background, which should be so much better 6+ years after the recession. Well, I guess in answer to the food stamps question, first of all, I didn't have time to look up the food stamps statistic, but the most recent chart I did see on this is that that food stamp usage is at or near record all-time highs, but most recently I think it rolled over and has been coming down. But usage of food stamps to me goes right to the poverty rate, and that's why I did want to show you this chart that I showed you in Tuesday's webinar. You can see that the poverty rate, not the absolute number in poverty, but the poverty rate is finally rolling over post a pretty good surge that we saw in and around the last recession. And again, this one is cyclically driven by recession. And at 14.5%, my point in the webinar last Tuesday was, well, guess what? Oftentimes people are focused on the absolute number in poverty, which goes to the absolute number of food stamps users, but the population has continued to grow, and so in percentage terms, the poverty rate today is no worse than it was 40 years ago, and it's a lot better than it was 60 years ago, and it's headed downward. So unfortunately, food stamp usage is just a necessary but not welcome development that's related to recession. Unfortunately, for those people who need them. This country does have a food stamp system, a system for food assistance. Mortgage lenders to ease standards. Won't that simply result in more home loan defaults, as with the subprime mortgage, since people have less skin in the game? I think this question probably was harking back to the slide that I showed you here. That was a description of a change effective December 1 in lending standards and guidelines, documentation. Now that's a different issue than lending standards. Let me try to clarify this. Let's state it a little more clearly. Lending standards is an issue separate and distinct from the guidelines issued by Fannie and Freddie relating to documentation of loans. What Fannie and Freddie were clarifying with the December 1 issuance of new guidelines were the specific degree of documentation for these loans. What happened was, post-recession and the surge in mortgage delinquencies is, in many cases, Fannie and Freddie were able to sue the banks that sold them the loans because they had inadequate documentation and even misrepresentations in mortgage qualification. Now, post-recession, it's turned out that banks have not ramped up their lending, have not resumed lending at pre-recession rates because they're afraid of getting sued on those same grounds as we go forward. And so what Fannie and Freddie realized was this is a problem. If we clarify these documentation standards, then banks will be once again willing to originate the loans and sell them to us. Banks won't originate loans unless they can sell them to Fannie and Freddie. And so I think probably this is good news, and I think that it is significant indeed, and that's why I brought it to your attention, because according to the Urban Institute, an estimated as many as 1.2 million additional home loans will be made annually pursuant to the clarification of lending standards. Do the earnings estimates include the much reduced earnings for the energy sector updated by S&P in mid-December 2014? The estimates being referred to in this question are from this slide that I presented showing both fourth quarter 2014 earnings estimates having plunged pretty dramatically over the last couple of months in this slide, and then on the next slide you'll see in a moment the annual earnings estimates. But the answer to the question is yes, they do include the dramatic downward revisions coming from the energy sector. And you may recall what I was saying is that prior to the dramatic cut in energy sector earnings estimates, we had been doing this. We had trended down in fourth quarter earnings estimates, just as we had been doing in each of the previous 3 quarters of this year. And that has been the routine phenomenon of analysts and companies encouraging analysts to shave their estimates going into quarter end so that they can ultimately surprise to the upside. So that accounted for the first half of these downward earnings estimate revision. And then the second leg down came directly from the downward estimate revisions from the energy sector. And that accounts for the downward revisions approximately twice the usual quarterly average, as you can see in this chart, which takes me now to the next chart. And this is 2015. The blue line here is 2015 and 2016. And yes, both 2015 and 2016 now do incorporate the downward estimate revisions stemming from the energy sector. So 8% had been about 10% year-over-year estimated earnings growth for 2015 post the crude oil price plunge. Do we need to be concerned about subprime auto loans fueling the auto sales and the effect on financials? I would say not. In other words, I think probably banks and also the auto companies. I just read, for example, that General Motors now wants to get back into auto loan financing, whereas it had sold off its GMAC financing unit post the financial crisis in order to reduce leverage overall for General Motors. So they sold their GMAC unit, and now they want to reconstitute an auto finance unit because it's a very profitable piece of the business. So yeah, I guess one could say, well, here they go again, but I think we're in early days, and with an improving economy, improving consumer spending, fully repaired consumer balance sheets, which by the way is another statement that some people raise eyebrows over. What do you mean, fully repaired? Yeah. The statistics suggest to me that balance sheets have been now fully repaired, and I showed you those statistics in Tuesday's webinar. So I'm not concerned about dramatic surge in subprime auto loans creating a problem, a systemic financial problem anytime soon. And secondly, the statistic I read the other day was really caught me by surprise, which said that actually auto loans have a lower default rate than home mortgages because people will more readily default on their mortgage payment than they will on a car payment because the car is the direct means to get them to their employer. Whereas they might default on a home loan and go live in an apartment. They're not going to default on an auto loan. So actually auto loans are actually a pretty strong source of credit quality. Slide 9, it reads 2013 forecast. Should it be 2014 or 2015? And the reference here is 2013 forecast. Yes, I made a mistake here, and this should be revised to read 2015 forecast, or more broadly, annual forecast. But although I did refer pretty heavily to the 2013 forecast here, having been so remarkably off base, remarkably short of what actually happened in 2013. And then Andy Gluck asked a series of questions pursuant to the webinar that I'll go through here in some detail, although I did respond to some of these questions post-webinar on Tuesday. So the good news is the middle class are becoming wealthier, but the bad news is the low-income earners are not becoming middle income. And what I pointed out is that no, actually that's a misstatement of the facts. And the fact is, according to the income distribution by household income bracket, is precisely the opposite notion here, and specifically it's that compared to 20 years ago and 40 years ago, both, we have fewer households in the middle income brackets today precisely because we have substantially more households in the higher income brackets, 100 to 150 and higher. An amazing statistic. And furthermore, I pointed out that in the lowest income brackets, we actually have a little bit fewer in the lowest 2 or 3 income brackets than we had as a percent of total households than we had both 20 and 40 years ago. And all of those figures are adjusted for inflation. What explains the bridesmaid effect? It's interesting to me that you find Leuthold's work in predicting to have merit when you're against market timing or tactical asset allocation. Good question, Andy, because as you know, I'm always ranting against tactical asset allocation. It's not just my emotional rant. What I've been showing you are the statistics in this regard that are so compelling, that argue so forcefully against trying to time sectors and styles and even the market itself, which is what tactical asset allocation is all about. The reason I guess more than anything that I bring bridesmaid effect to your attention is that it suggests not to make tactical asset allocation bets in the sectors that lagged last year. It's not so much that I'm in favor of placing your chips on the bridesmaid sector, although the research here to me is pretty darn compelling, suggesting that if you did put the chips this year on last year's second best performing sector, the probability is really strongly with you in selecting a sector that's going to outperform this year. But I guess the key value more than that in bringing this to you is to suggest to you, to discourage you from being tempted to do a tactical asset allocation bet on the stuff that didn't work last year, believing that you're probably finding something that is so beaten up and out of favor that the cycle will turn, and you're going to find the energy sector, for example, the worst performing last year, is suddenly going to turn around and shoot the lights out this year. Statistically, that's clearly not what has happened, and that's going to those would be bets that would probably hurt you. So I guess more than anything, I'm bringing Bridesmaid to your attention again as part and parcel of the broader argument not to do tactical asset allocation, and in this case, not to try to pick the laggards last year, hoping that they'll become the leaders this year. Statistically, that simply hasn't held up. What do you think the Saudis are doing? Your analysis ascribes purely financial motives in explaining Saudi opening its oil spigot, but are there also political motives at work? Are they driving down prices for reasons other than OPEC politics, like to send a message to destabilize Assad? I don't know. I mean, I'm the first to say that I'm certainly not an expert in global politics, but I think what the Saudis are doing and announced that announced in November was simply a step, an attempt to fight back against the trends that have been beating them up now for more than just the past year. Specifically, what you saw in the statistics I presented was that Saudi production has actually been been cut. Saudis have actually had to cut to compensate for an increased production from Iran, Iraq, and Libya. And Saudi has had to cut in response to dramatic surge in U.S. production. And what they're saying is, well, guess what? If we allow oil prices to plunge, we're going to fix this situation. Well, first of all, our brethren in OPEC and outside of OPEC, Russia may think twice. They may come back to us, and I was making the case that logically they should come back to the Saudis and say, well, okay, we get it. We understand why you're unhappy. If we all gather together and agree to cut, all of us take some of the pain, take some small pain, and spread it broadly among all of us, then we can probably turn the oil price around pretty dramatically. And also, I think the Saudis did make a very rational calculation, thinking that, you know, at some point, shale production in the United States, at some price point, shale production in the United States really will suffer. And the Americans really will stack rigs in a dramatic fashion at some point. And that price point probably was unknown precisely to the Saudis, but I think they probably had a pretty good idea that if we hit 60 or 50 or 40, man, we will see a dramatic supply response coming from the United States. Economics will simply dictate that that will be the case. So those are my explanations of the Saudi actions, and beyond that, destabilize Assad and other geopolitical considerations, I don't know. I've read those things and they do make sense, and also the Saudis hate Iran and they'd like to inflict some pain on Iran, no doubt, and perhaps this is part and parcel of their considerations. And the second and the final question here, what's the effect of the oil production curtailment on U.S. economic growth? And I think I covered that pretty extensively during the presentation. I said that, well, if you just look at consumer spending on gasoline and diesel and home heating oil, the three ways in which crude oil prices directly affect U.S. consumers, well then what you realize is consumer spending on those categories as a percent of GDP is 2.4%. And if you have a close to 50% cut then in that price, then that frees up approximately 0.9% of U.S. an amount of spendable cash equal to approximately 0.9% of U.S. GDP. And I further went on to say, yes, but to assume that the plunge in oil prices will contribute a full 0.9% to U.S. GDP growth in 2015 is probably being optimistic. It's probably overstating the case, because the negative offsets to that calculation come from both a decline in U.S. drilling activity. In other words, the negative impact on all of those industries and the economic multiplier that I was talking about earlier, that will come into play. And so that takes something away from a 0.9%. And also it assumes that Americans will spend every nickel of what they save on gasoline, diesel, and home heating oil. And I don't know whether you can make that bet or not. I tend to believe that Americans in the end probably will spend most of what they save, but maybe not immediately. And so it could be that they won't in the end spend nearly that much, or that there's a lagged effect. First they bank some of the savings, and then over time they'll feel confident to actually spend some of that money. So we'll see. Anyway, the bottom line on the crude oil price cut plunge is probably something on the order of 0.5% GDP growth incremental on top of what most economists previously had been thinking was maybe 2.9% GDP growth in 2015, which would put you well north of 3% GDP growth this year and next year, as being what most economists are concluding to be the effect, the positive effect on the crude oil price plunge.